let's talk about what your mortgage payment consists of. So we always talk in acronyms in my business with the PITI or PITI.
It's not Mr. T.
But I pity the fool. I pity the fool.
No, it's not.
Hi, I'm Kenny Klaus, and this is State 48 Homeowners.
Hey, my friend, welcome back to the State 48 Homeowner Podcast. And today we've got Steve Farrington from Unity Home Loans. Welcome back, Steve.
Hey, Scott. Glad to be here, man. How are you doing?
Excellent. We've got a lot of first-time home buyers out there.
We do. They make up usually a little over 1 in 4.
And especially in this market, because we've got a lot of sellers that aren't ready to sell because they got those super low interest rates.
Right.
And so now we've got more and more of the market of buyers that are first-time home buyers. And a lot of people are wondering, what is the best mortgage to get?
Best mortgage for a first-time home buyer? All right. It's a good topic because there's a lot out there. So let's just kind of go over the different types of loans and mortgages first. Yeah. So there's two different categories really. There's the Ginnie Mae or A loans, the government loans. And the A loans are the ones that end in A. You've got your VA loan, you've got your USDA loan, and you've got an FHA loan. So unless you're a veteran or active military member or surviving spouse, you're probably not getting a VA loan, but a fantastic product nonetheless. USDA loan, rural area, so not a lot left available unless you're outside of Maricopa County. Nothing in Maricopa County. So we'll primarily focus on FHA for first-time home buyers, and then there's the other body, or as they're referred to, conventional loans, which is your Fannie Mae, Freddie Mac. So those are your conventional loans. And then we can talk a little bit right now about down payment assistance, because a lot of people think it's a different type of loan product. It's not.
It's an overlay.
It's an overlay. It's basically just in addition to the current or typical conventional loan or FHA loan. The one thing you need to be educated on, working with the loan officer when you're looking into DPA or down payment assistance programs, is that some of them can have a second lien payment. They can have a higher interest rate. They can restrict your ability to buy, sell, or refinance within a certain time frame. So just make sure that you fully understand.
We just want to know those limitations up front and be aware of it, because if you're planning on moving at some point, you just want to know those time frames. It might be 2 years, 3 years, 5 years.
Right. You
just want to be aware of what's going on. You may not be able to move and rent that place out.
Yeah.
You may not be able to sell it for a while, and if you are going to sell it, you may have a lump sum that you have to come up with, which is just paying back that down payment.
And some of the assistance programs, they're technically a forgivable second lien, but they've got a payment with them. So it's also the qualifying. I mean, the basics of it is it's not a separate product. It's just an overlay, like you mentioned, to conventional and FHA loans that we'll be talking about today.
And just know it, right? Know what you're getting into, but generally, it's a pretty good deal.
Pretty good deal.
Yeah,
absolutely. So now that we've talked about the mortgage or loan types, let's talk about what your mortgage payment consists of. So we always talk in acronyms in my business with the PITI or PITI.
It's not Mr. T. I pity the fool.
No, it's not. So the first part of that, the P&I, is your principal and interest. Now, principal and interest is basically your payment based off of your loan amount, the interest rate that you're receiving, amortized over the term of your loan, your 15, 20, 25, 30-year term.
And so the PI of that amount, the two of them together, unless you're refining, that amount is going to stay the same.
Fixed. For
either that 15 or 30 years, depending on what that is. But the amounts that make it up are going to change monthly. The total amount stays the same.
Right.
But that principal amount, that interest amount, those are going to change based on that amortization.
Amortization, right. The longer you pay into it, then obviously you're paying less interest, more principal.
Yeah, so when you start out, it's super heavy on the interest. And then you get down to the end and there's, it's all principal.
We print off the full amortization schedule for a 30-year loan now as part of your closing documents. It's about 7-8 pages depending.
And so most of the people, when we get to closings, most of the people just go, oh, that's a lot of numbers. And then some of them are going, oh, yeah, that's numbers.
So the T&I portion of that then is going to be your taxes and your insurance.
And those change.
They can change depending on, let's talk about them. So the T&I, you've got your taxes, you've got your insurance, and then we'll also talk about private mortgage insurance, because that can be a piece of it when you're putting less than 20% down, or depending on your loan type. So taxes, obviously, going to vary depending on where you buy in the valley, right? I mean, certain areas. So something you need to be cognizant of when you're looking at a home, just because it's a $500,000 home or a $450,000, $500,000 home you're looking at with your agent, maybe the taxes are $2,400 a year in this specific neighborhood. Maybe they're only $1,500 a year in another neighborhood for a comparable property. Yeah. So again, can save you $85, $90 a month. Similar property, different area. So again, just be wary of that, because that can affect your ability to qualify or your total housing payment.
And in Arizona, taxes will go up, but there are limits as to how fast they can go up.
Absolutely. And then you've got your insurance. So insurance, number one, is going to be your homeowner's insurance. Yes. So you got to have homeowner's insurance. Typical homeowners insurance, people have a relationship through their auto, especially first-time home buyers, because they don't have homeowners insurance relationship. So they'll go through their auto insurance carrier, try to bundle it, which can save them money. We'll bring Flo from Progressive into the conversation, and
Jake from State Farm.
Everybody. We'll cover everybody. Sponsors. But homeowners insurance can vary as well. And a qualified loan officer or a professional like myself, I mean, I'll get somebody's homeowners insurance quote, and I'll be like, for that property, Scott, that you're buying, that seems a little high depending on the coverage. So maybe get 2 or 3 different quotes, go online, I understand, and sometimes they'll tell you, hey, that's fantastic. It's a great
And you've
quote.
got time during closing.
100%.
Yeah.
100%. It's not needed.
You don't have to get that first quote. It doesn't have to match your auto, by the way.
Amazing. Absolutely.
Probably could get a good deal that way, but it doesn't have to.
Right.
Brokers are great, by the way. Insurance brokers are great.
Yes, they are. So are mortgage brokers. But then you've got the private mortgage insurance. And private mortgage insurance as well can be a variable, especially when we're talking about conventional loans. Not so much FHA, but let's talk about private mortgage insurance a little bit, because that can affect, again, that total monthly payment when you're qualifying.
Yeah.
So again, you've got the P&I, principal and interest, loan amount, interest rate, amortization. Then you got the variables like property taxes, insurance, and PMI. So PMI is your private mortgage insurance. So that's what Fannie Mae and Freddie Mac, that's the acronym they use for the private mortgage insurance, that they require buyers who put less than 20% down. Yeah. In most cases, we're seeing first-time home buyers put anywhere from 5 to 6% down as the average.
And this is something that if you don't have enough skin in the game, this is something that the bank is requiring you to have to insure yourself, insure the mortgage, to make sure that it's insured up to the level of the skin in the game that they want.
100%. That's well put. Well put. So the PMI factor, or the amount that you're being charged, and again, we're talking just conventional loans, Fannie Mae, Freddie Mac, that's going to be based off variables like your credit score, the loan to value. So again, first-time home buyers on conventional loans, Fannie Mae, Freddie Mac, can put as little as 3% down. So again, the variables in that PMI are going to be credit score, your loan to value, like we talked about, the amount of the down payment, your debt to income ratio can affect it. The number of borrowers can affect that PMI factor of what you're being charged. So again, as those variables, if your debt to income ratio is a little bit higher than they like, maybe you're paying a little bit more in the private mortgage insurance each month. Maybe your credit score is in a 765, maybe it's a 748. You might pay a little bit more. So those are the variables that go into that private mortgage insurance. And again, it's all those risk tolerances that the lender's looking for to cover that gap between the 20% equity and basically what you're putting down.
Hey everyone, this is Kenny Klaus with Klaus Team Real Estate Solutions. We know there's a lot of confusion in today's market, whether it's billboards, TV, radio, mail. Everyone's trying to get your attention. They offer one lane, where at the Klaus Team, we have over 20 different programs. We can help you navigate through to find out what's best for you. And remember, we work for you, they work for themselves. We're here to represent you and make sure you have the best experience possible.
Visit us at klausteam.com/call-us-first.
So let's go to FHA. So FHA, they call their PMI MIP.
Because they got to be different.
Right? So that's based on a set standard, meaning that the factor that they use to calculate it is set, regardless of credit score, I won't say regardless of loan to value because they actually lessen it if you put 5% down or more on an FHA loan by a small percentage, but it makes a difference. But there's less variable in it. Now, it's a higher factor than in some cases for conventional, but it's standard whether you have a 620 credit score or a 748 credit score. It doesn't matter. It's going to be fixed, that set factor against it. So those are the main differences when you're talking about the monthly expense of PMI. Now, the PMI or private mortgage insurance, or MIP for FHA, just to be fair, they have a couple other subtle differences, and I think you're pretty well aware of them, right? So, PMI with Fannie Mae, Freddie Mac conventional loans, it can be canceled.
Yes.
FHA, on the other hand, is permanent.
It's permanent. It's there.
It's permanent. It's there. So on the cancellation piece of it, there's some variables that go in, and it can vary per lender and servicer, but typically you can request that your private mortgage insurance on a Fannie Mae Freddie Mac loan be canceled when you reach 80%. Your principal balance reaches 80% of your original loan, your original value.
And for a lot of lenders, sometimes our clients will reach out to us. A lot of times now we'll reach out to our clients and say, hey, it's about that time. We've looked and your property has appreciated. And here are some comps. Send these over to your bank and request that they remove that. And in most cases, the bank will do that.
I mean, there's some paperwork that goes involved with it. It's a process. It's
not every bank.
Not every bank, but
sometimes
it's well worth it.
Yeah.
I mean, it's well worth it. And it's kind of a nice feature, especially if you plan to stay in your property. And as we see homes continue to appreciate, the values continue to appreciate in Arizona, it's a nice that, obviously a real estate professional is going to reach out and say, hey, we pulled some comparables. You might be able to save $100, $150, $200 a month without refinancing.
Yeah. And that's just
limiting your
money
PMI.
that's going.
Going bye-bye.
Yeah.
Right?
It's not paying down your principal. It's not taking care of it. Interest. It's just going away.
And there is a piece of it that if you get to a certain piece of equity that they're supposed to cancel it automatically, I wouldn't rely on your lender or servicer to do that. Not bashing, my industry, but I wouldn't rely on them to do that. You might have to call it to their attention. But with FHA, the MIP, that monthly premium that you're paying, that's part of your, part of that payment every month, it doesn't come out.
No, there's really only one way, and that is to refinance out of that FHA, which then you actually have to qualify for a conventional. And so if you weren't able to qualify for a conventional and you needed to go FHA that first round, hopefully something has changed that now you can qualify for a conventional.
Well, and in a lot of cases, and again, I hear this a lot, is that people consider FHA, people have a little bit lesser credit, or maybe they had a hiccup, or they're just building their credit. And maybe they've only got a 680 or a 690 credit score. So they go FHA because they can qualify FHA just a little bit easier. And we'll talk about that a little bit later. But within a couple of years, now their scores in that 750, 760 range, 780 or higher. And with the appreciation in their home, they can refinance and either eliminate that PMI factor or monthly, or lessen it dramatically because their FICO's improved and they can go to conventional, and then it'll drop off at that point, going from FHA to conventional. So,
and on top of that, we might even be in a better rate environment too.
Absolutely. So let's talk about just a little bit about interest rates, because that is part of that first feature. So very similar to the private mortgage insurance, obviously, is going to be the risk factor. So a lot of those same variables or factors that go into your monthly PMI for Fannie Mae and Freddie Mac also go into the factors of your interest rate. So if today's interest rates are 7% for a 760 FICO score, putting 5% down on a 30-year fixed mortgage, it might be a little bit more, maybe 7 1/8 or 7 1/4, and they've got a 726 FICO score. Or maybe they're only putting 3% down. Because again, you're raising those risk tolerances. So that's where the factors also play into interest rates, or can affect the interest rates for a conventional loan.
Okay.
FHA, on the other hand, is, again, pretty much there's no penalty for having a lesser credit score. So, again, you're talking somebody with a 680 FICO score is going to get the same interest rate on an FHA loan with a 765 FICO score. And let's say those are at 6.5 or 6.625. So again, those variables can play into it as far as what you're going to receive, as far as your interest rate. Those factors make up the same. There's other things that go into your interest rate as well. Property type. So condos can sometimes have a higher interest rate versus a single family, manufactured housing versus a single family or townhome. The amount, again, that you put down, 3%, 5%, 10%, 15%, can all affect that on the Fannie Mae, Freddie Mac conventional model. So again, all variables, but all have good and bad factors. And that's why you kind of have to weigh FHA versus conventional products when you're a first-time home buyer, depending on your credit score, depending on how long you plan to be in the home, depending on what you need or want your monthly payment to be, or sometimes even the property type that you're buying. Because as you know, as a licensed real estate professional, some property types don't qualify for FHA. Am I incorrect?
Yeah.
So that can be a factor as well, in depending on what loan product that you're using. So, and that goes into the qualifications. I mean, that's conventional versus FHA. There's all those variables, and that's why, when I talk to a client or, when we're talking about that initial pre-qualification, what's your FICO score? What's your income at? What are your debts? So we can put all those numbers together so I can show them, hey, here's conventional, here's FHA, educate them on both the products and let them choose what's best for them.
And that's another reason why it's so helpful even early on in the process to meet with somebody like you,
right,
to plan things out and go, well, how much down payment do I actually need?
Right.
Because I think a lot of people think that they need to save more of a down payment than they do. And, it may not make a difference in the interest rate, like you said before, to save, may not make a difference between a 3% and a 5%.
Absolutely. And that's the key. I mean, if you're truly a first-time home buyer, and again, let's qualify a first-time home buyer. That's anyone that hasn't owned a home or been on title to a property in the last 36 months from application date. So if you haven't owned a home in the last 3 years, you're now a first-time home buyer again. Maybe you moved, or maybe, life changes, right? Mm-hmm. We all know we have those life events that can change. So again, it's not just somebody that's never owned a property before. I mean, hey, if you took a 5-year hiatus from home ownership and rented or traveled the world, who knows? But you're now a first-time home buyer again.
It's crazy definitions.
Again, those are all the things that I have to deal with and that I can take off your shoulders. So what else do we need to talk about?
So qualifying between conventional and FHA.
Okay. Qualifications. So I won't go into the details of it, but really when you're qualifying for, any type of mortgage, you're going to want to have, job consistency, income, a 2-year history. They're going to want to know that. It's a little bit more forgiving on conventional than FHA with certain job changes or moves from industry than it is with FHA. FHA really likes to see consistency because, again, it was developed for true first-time home buyers back in the day. But again, not that it's harder, just, again, working with a professional. Debt-to-income ratios. So again, your gross monthly income divided by your total debts, including the new house payment, FHA is a little bit more forgiving than conventional. It can be a little bit higher. So maybe you have some variable income that we don't include in your qualification. You're like, okay, well, I could go a little bit higher in my debt-to-income ratio because we're not using that for qualification. So again, FHA can be a little bit more forgiving there. And then also, like we talked about, credit. And really kind of those dings that we have on our credit. FHA, again, is a little bit more forgiving when qualifying borrowers that have debts, whether it's a small collection or a charge-off, or maybe they just don't have, a long credit history. It can be a little bit more forgiving. So again, a little bit easier as far as like guidelines in certain aspects for FHA, but then again, with conventional, there's some guidelines there that are a little bit easier if you have that job consistency, if you have that higher FICO, if you have a little bit of savings well, maybe they'll go up a little bit on their debt to income ratio. So it's all those compensating factors and putting those pieces together. So those are the qualifying pieces between the two. I mean, you'll hear, a lot of times when you click on YouTube, it's like, oh, FHA is so much easier to qualify for. It's for people with bad credit. I'm like, no, not really. It's just maybe people that don't have that length, that depth, that history, or maybe, hey, had a life event, again, like we talked about, that affected them 3, 4, 5 years ago, that their credit score, they've built it back up, but it's just not to the level it was prior to that event happening. And that's usually what I see.
So if you're ready to take the next step, or if you're ready to start the conversation earlier rather than later, you can talk to Steve or you can talk to any of our real estate professionals, all at the same place. You can reach us at klausteam.com or call us 480-354-7344. Thanks a lot, Steve.
Awesome. Thanks, Scott. I appreciate you having me.
Thanks for spending time with us this week at State 48 Homeowner, the ins and outs of owning an Arizona home. You can connect with us for more information, submit topics you'd like us to further discuss. You can see relevant videos, give us feedback, answer your real estate questions, and more at state48homeowner.com.